Welcome to the Let's Talk Property with MFS podcast. MFS are a bridging loan and buy-to-let mortgage provider and not a financial advisors. The opinions expressed in this episode are personal to the host and guest and may not reflect the views of MFS. Hello and welcome to another episode of Let's Talk Property with MFS. This is the podcast where we're going to talk all things property. Today, we're very fortunate enough to have Kam from Premier Property here today. Kam, just want to say a big thank you for coming down today.
Thank you for inviting me.
Yeah, no, more than welcome. And, you're someone that's very well known within this industry. We see you everywhere at the moment. So it'd be nice to know a little bit about how you got into the property market and, how you sort of moved into the educational side of things as well.
Well, yeah, sure. I mean, I fell into this by mistake, actually, at the age of 19. Back in 1989, that's how it actually started. Like many people, they fall into this stuff. And then 30 years later, I'm just a property investor and developer, investing for the last 30 years. And we're active now. So we typically do 9 to 12 projects on a monthly basis, varying from buy-to-lets and HMOs to 9, 10 unit developments as well. So I'm the founder of Premier Property Group.
Yeah.
And one of our companies is Premier Property Education, which is the leading UK-focused property training company in the world.
And how we met, funnily enough. We met through the Premier Property
Group.
Group.
Through this way, isn't it? A lovely network, absolutely.
So just sort of want to touch, you mentioned HMOs there, and it's something that's been quite a hot subject recently. So, I mean, you're doing a lot of HMOs at the moment. Is there any particular reason you're going for that sector of the market? Is it because of the yields? Is it be able to get through the stress testing, the affordability? What do you see in HMOs that makes them so popular for you?
Well, Mark, I mean, you're in finance yourself, and of course, you're looking at stress tests, and stress tests are going up. Big problem investors are having is that the loan to values are much lower because of the financial stress tests. So HMOs are a great way to overcome that. Of course, the rentals go up because you're renting out room by room. And because you're doing that, your investment, your income coming in on a monthly basis annually as well, of course, is going to be much higher. So the stress tests for finance work really well. So obviously you're the finance guy, but in terms of the property investor side of things, where we normally go to a sort of leverage of 75%, we can still do that in satellite and larger towns when we're doing it with HMOs. So HMOs tend to work really well for investors. And in my view is 2023 moving forward, I think it's one of the key strategies in the property industry of the next decade, really.
I think you're 100% right there, because we are seeing at MFS more and more inquiries for people wanting to finance HMOs, also holiday lets as well. I mean, there are particular areas that you go for. Are you looking for student towns? Are you looking for, or is it just anywhere where you can see it fits?
Well, good question. So we look for specific types of clientele, because the thing about these houses of multiple occupancy, the HMOs, I'm sure the viewers understand that. Just in case someone doesn't, just to be clear, we're renting out room by room. So it's room rentals, room by room, and that's what it is. And the key with HMOs is to be able to occupy the properties. You'll be hearing people saying about, you can get 12% yields and 18% yields and 20% yields. You only get those yields as long as you can occupy those properties.
100%.
And those occupiers actually stay there, and that is maintained. So that's the key part. So in order to do that, you need the right type of clientele. So we've actually got 4 specific types of clientele that we focus on.
Okay.
So the first one is students. That's my personal favorite. I love working with students because we know there's a clear timeline. So we know when they're going to come in, we know when they're going to leave. The whole system is working, and we know when they're going to come in again. So the cycle works really nicely.
It's normally July to July, isn't it, I think?
Yeah, so yeah, it's quite right. So around that sort of time. And you can it's very measurable. I like to do things where you can measure your results. So the fear reduces, and you can create income with confidence. So students is a great one. The second one I'll share with you is NHS staff. NHS staff right now, as we're all aware, my son's a junior doctor.
Yes, he is.
So NHS staff are always looking for good quality, and it's got to be good quality.
Yes, of course.
HMOs. So they're looking to share accommodation. So they're very good, and very competent people, of course, as well. So that's a good one. The third one is young professionals. Young professionals, we've all heard about young professionals, professional people. The ones that we find work the best are the ones that have actually got a degree and they've just come out of university. The ones that are used to living in HMOs already, you see. And people are traveling to where the jobs are, where the work is. So, these young professionals coming out of university with degrees, after working so many years, they're chasing these jobs, and they make really good clients. And the fourth one is retailers. So areas where, let's say, you've got first generation immigrants, like my parents were, this country. So really hardworking people. They want to work for their money, but they haven't got a lot of money. They're just trying to minimize everything they possibly can in terms of costs. So they're really good. So retail environments, warehouses, Amazon types of big, large warehouses, that kind of places, those kind of places, they're really good. So they're the kind of four types that we look for in that order, actually.
Really? Well, look, they're a perfect sort of clientele, and I can see the obvious reasons as to why you do them. So, I mean, we want to touch on today. I know we were on one of your panels a couple of weeks ago at the RAF Club, and we kept hearing people talking about the perfect storm, and it's something that we sort of covered off. So, what would you define the makings of a perfect storm? What do you, in your eyes, do you see as a perfect storm with, rates, or is it just a mixed bag of it all together, really?
Yeah, so I often wonder about this perfect storm. So when people talk about a perfect storm, are they talking about the perfect storm where everything is wrong, or are they talking about the perfect storm where everything is right?
Well, it's normally where everything's wrong when people are talking about it. It's like
which is quite interesting, because there is quite a lot of difficult circumstances happening out there for the informed investor. But for the non-informed investor, But for the informed investor, actually the perfect storm is everything in the right place, like was. I mean, we can talk about that specifically if you like.
Yeah. So, I mean, do you think we're in a perfect storm now, where sort of indicators, what sort of indicators you seeing? Seeing people sort of try and shy away from the market because of interest rates, because of the stress testing and all these things, cost of living's going through the roof. What are you seeing, sort of thing? You're seeing less people doing deals within the marketplace? You're seeing just as busy as it is now? Well,
there's a lot of fear out there. Let's keep it honest, right? So interest rates, look at the number of rises we had, double digits now. Number of rises that we have in interest rates, and by the time we've got this out here, the podcast that we're doing here, there'll probably be another interest rate rise. So there's all that happening. So people are really scared about that, and rightfully so. Also legislation. There seems to be more and more legislation. The landlord seems to be the easiest hit for the government, and although there's a shortfall of accommodation required for over 300 units per year, at least for the next decade, year upon year. The private rental sector is really required. Landlords are needed. However, landlords seem to be the easiest target when it comes to legislation. So there seems to be more and more legislation, and of course the Renters Reform Bill that has just come in and is now being legislated for. On top of that, we've got high rising inflation. I just keep it honest. My view is the inflation figures that we get aren't actually the real inflation figures.
You always say that, to be fair.
In real terms. I mean, yes, okay, so price of oil might be going down, price of fuel might be going down, but you only got to go to your local supermarket and find out, how the heck is that costing me this? In terms of
eggs,
what you just bought. So there's all that going up, isn't there? So I mean, there's a lot going on. So there is a lot of fear out there. At the same time, for the informed investor, all of these things are actually very, very opportunist. There are such opportunities, great opportunities. And I'm not just saying this. We act upon this. So I live what I'm sharing here with you.
And that's what I love about you and everything you guys do. You're not only providing people the education, you actually do it yourself. So you're showing people how you do it in real life.
In real life stuff, and I think that's important, isn't it? So myself, my wife, my family, my kids, they're all into property. I suppose I've instigated. But we're all doing this. So everything I share, we're doing. So specifically, let's look at this. Let's look at it, in a sort of a factual matter, right? So if you look at interest rates, if you track back interest rates for over 100 years, we'll find that they normalize around 6 to 8% when it comes to the Bank of England base rate. And look at where we are right now. So of course the lender's got to make a margin. They've got to, everyone's got to have their fair margin in that. And what we're finding right now where we are, the interest rates are very workable. So what we've had over the last decade really has been a bit of a dream, really.
And now it's just back to reality.
Back to reality. I mean, if someone said to us, I don't know what you think about this, Mark. If someone said to us that we're going to have a pandemic yeah, the whole of the world's going to be shut down. Yeah, the Bank of England base rate is going to be 0.25%. We would have thought it's a science fiction movie.
Yeah, I would have said you're off your head.
Yeah. However, it's happened, isn't it?
Yeah.
Yeah. So what we've had is been a bit of a dream, and what we got right now isn't really, in terms of interest rates, expensive. Funding isn't expensive. It's very workable right now.
If you've got the right deal and if you're looking at the right sort of stuff. And I think the UK property market is very resilient. From when I'm sort of reading our friends across the pond at the moment, they're having an absolute nightmare. Even in Australia at the moment, the state of the property market there has gone absolutely berserk. And inflation, they've just announced, I think it was this morning, that inflation's gone up there. So I think you're going to see, it's not just, we can demonstrate that the UK market inflation is dropping now. Like you said, there are the right deals there. If you can buy stuff maybe below market value, add some value to it, and then refinance it out, all of this sort of stuff. I mean, what do you see sort of like good sort of deals? What sort of profit margins do people need to be working off of to try and make these numbers workable in your experience?
Yeah, so it depends on the type of deal that you're doing. So when it comes to uplifts, for developments, we're looking at minimum 20%. Yeah. Really, we're looking at 30% because we're factoring in any unseen circumstances. I suppose the way we look at deals is like your financial underwriters will look at the deals. We have the same sort of ethos assessing
balances,
deals. Yeah. So we want to make sure that there's a good margin, so there's some flexibility in there. That's kind of where we're looking at right now. Also, when it comes to yields, if you're looking for rentals, our rentals start from a minimum 7% gross yield.
Okay.
Yeah. So that's where we start from. For HMOs, we're discussing HMOs. Our minimum gross yield start from 12%. Yeah. Right. So when you're factoring in numbers like this, you can actually ride some of the waves that are happening out there. Things that are outside of our circumstances. And we're discussing interest rates earlier. So interest rates, very workable. Yep. Inflation, the fear of inflation for people. When it comes to funding, though, so we use good funders like yourselves, and when it comes to funding, when we think about that, really, what we're doing is we're getting the lender to actually pay for most of our deal. So typically around 75%, let's say, is a good number to be working at. We find that very active, and we find that to be
there's more more products available at that rate than trying to push it any higher.
And that financing, if you think about that money is being borrowed by the lender, of course. Now, money doesn't differentiate between whether it's in your bank account or whether it's being borrowed by a lender. Money is money. Yeah. So my point is, money is being eroded by inflation. So let's say we're now double digits of inflation. Yeah. Let's just say it's 10% inflation. Your £1 million or 100K, whatever the number is, let's just say 100K. That 100K in a year's time is worth, in real terms, 90,000. Yeah. In the same time, when you think about it, that money that you've borrowed for an income-producing asset or a trade that you're doing with that asset, which is going to generate profit for you, that money that is borrowed is also eroding, isn't it? Yeah. Yeah. And a lot of people miss this, actually, yet it's so simple. So in an interesting way, inflation for the investor, the informed developer, actually works in your favor because inflation erodes over a period of time the debt that you actually hold. And good people like yourselves, they'll lend the money.
Okay,
and we'll use inflation to erode it. So in an interesting way, it's a very deep point, actually. It's one of the reasons property assets are a great asset to be investing in. So yeah. And
I think it is, there is a huge difference between the uninformed and the informed investor. But you see more people that would, it would be classed as sort of maybe uninformed and now trying to make themselves more informed to keep up with everything. Because we always say about it, if you're investing in a certain area, do your research on the area. Be checking your numbers, checking them more than once. Making sure the deal works, doing all this sort of research, keeping abreast with what's going on in the market, listening to things like this, going to events that you guys hold. Do you think it is key now more than ever to be doing your research and studying these markets if you're looking to get into it, or even if you're already in it?
100% agreed. Very important. The thing about research, though, is sometimes people can end up with analysis paralysis.
Yeah. I knew he was going to say that.
Yeah, it can be a little bit too much research. But on the other side, people can take action and then it doesn't work for them because they haven't done the research. So it's kind of a medium ground, isn't it? So let's discuss some. Should we discuss some specific?
Yeah, please do. Yeah, of course.
So when you're looking to invest, so we've already touched upon for an uplift. Yeah. Minimum 20%, and your lenders will be expecting that anyway. Yeah. So if you're listening to this, be aware of that, 20%. adding an extra buffer in times of downturn like we have right now. So, where the contingency we have at Premier is we'll add another 10%. So we'll look at deals, good deals, where there's a 30% margin. That's not 30% margin from purchase price, that's 30% margin after all costs. Yeah. So we've got to keep that in mind. So your stamp duty, your solicitor's fees, etc., etc. All of that goes in there.
All that fun stuff.
All that fun stuff goes in there as well. And you've got to pay people, haven't you? To provide a service, you've got to pay everybody.
100%.
Yeah. The uplift. The second thing that you want to be looking at is also the gross yields. Like what I mentioned earlier, just to summarize, 7% minimum for rentals is what we look at Premier. And also the key number that you really want to be looking at is your capital deployed. Yeah. So your return on your capital deployed or employed, if you want to say. So the ROCE or ROCA or whatever, how do you pronounce it?
Well, I'd say ROCA. Yeah, whatever.
ROC, let's just call it ROC, right?
So return. Okay.
Yeah, so your return on capital employed, that is the key measure. Because like we were discussing earlier, you can leverage finance, you can refinance by adding value. So the way we do this is we make sure that our return on capital employed at some given point in time is actually infinite. Yeah. Now, sometimes that happens next day. Does happen. Sometimes it happens in 6 months. And we put a timeline on that of maximum of 3 years. So there's a balloon of 3 years within every single pound that has been in that property, has been invested in that property, comes back to you. Now, when you start thinking like this, then what you now become is like us. You become a momentum investor. Yeah. So you're not just going out there, buying stuff randomly. What you're doing is you have a strategy, you have a method to your plan, you have a plan. So these numbers will really help you do that. And these numbers, I would suggest that anyone who's listening to this, get these numbers worked out right from the beginning. Yeah. Because one thing that will buy you is peace of mind. And the truth is you can't buy peace of mind. No. So peace of mind.
Especially once you pay the deposit and then you realise your numbers don't work, you sort of, point of no return there.
Yeah, so keep some real key numbers to work in. And it's not rocket science. If I can do it, anyone can do it. I would say, I suppose what we've got is what we've built up over the last 30 years is good systems and processes that actually work, that actually a 12-year-old child can follow.
And they're ones that you're strict and you adhere to regularly. Don't go off piste if it doesn't fit those numbers. Well, I think when we had lunch the other day, we were talking about people that emotionally invest, that can that's how you end up losing money if you don't have a cut-off point for something, or if you purchase something in auction, you just keep bidding, even though you're bidding more than the highest price on the street. But I mean, how many deals would you say, I know you say you actively do between 10 and 15 a month, how many deals would you look at to narrow it down to those? Is it a very high number, I'm guessing? Yeah,
so top level, we can discuss the numbers. And the emotional part, by the way, if you're like me, you can't help but be emotional. So these numbers help you to make sure that you're getting into the right deal.
I'm the same.
Because we're only human, right? So it's all right to be emotional, but just, you just got to make sure we're doing the right thing, right? Yeah. So in property investing. So in terms of top line figures, so I now have a senior analyst who does this for me on a daily basis. However, it wasn't always like that. So anyone can do the numbers. So I used to do the numbers. So in terms of deals that you're looking at, you could be looking at typically, as an informal investor, out of 40, so some of my students, for example, out of 40 viewings that they do, they will find a good deal. Yeah. Now, the caveat there is they've learned our system. Yeah. I have to say that bit, right?
Well, you guys offer the chance for people to come in and run through a live deal with your analyst, don't you? Where they can sit and say, right, we're looking at this, and you'll help check their numbers and run through the deal to make sure that they're doing the right things.
We do our best to assist people who want to be assisted. We help them out if that's what they want. We do that, yeah. So 40 deals can get that. In terms of development, top line, we look at every week, I would say around 100 to 150. Wow. Now, I'm not saying, that might sound like a lot. However, what you've got to remember is each one of these is less than 15 seconds to go to the next vetting process. So we're talking top level 150. And it's very quick checks.
It just sort of funnels out to the more nitty gritty, where you start drilling more into the devil in the details. So you've got your quick one, right, it's not going to fit that. You probably lose 50 properties doing that, and then you lose 25 on the next round, and so on and so forth.
Exactly. So you end up with a short list, and the short list is what you work on. Hope I'm answering your question.
Yeah. You always do, to be fair. So I wouldn't worry about that. So as we've been doing, we've been touching on a few bits over the course of this today about the perfect storm, or whatever people would perceive it to be. Do you see landlords leaving the market at the minute? I keep hearing these stories about, it's always in the papers, isn't it? Doom and gloom, 100,000 buy-to-let investors will be leaving every year and all of this. But
so the way my personal view, I like to keep assets.
yeah,
Use it as a metaphor or analogy, you can call it. Why would you want to kill the goose when you got all the golden eggs?
yeah.
But that's just my view. Yeah, trading is good as well.
Yes.
So we do trade. I normally trade with joint venture partners because there's a nice clean exit. So people want to joint venture with us. We will do projects like that. So just literally for the clear exit, and there's a profit there. So that's happening. However, answering your question directly, what we're finding is there are landlords leaving, and what I'm finding is a lot of portfolios landing on my desk. People that are selling up. Quite sad. I find that quite sad actually, because if these investors are business people, they've been investing for a very long time. They're just tired now. They seem to be so tired and worn down.
A lot of them are over retirement age anyway, and just seeing this as sort of the perfect time to think, you know what, I've been doing it for 30 years. I might as well just start selling up.
Yeah, but my view is if they just looked at it with a fresh pair of eyes, if they were just slightly more informed, if they were just looked at what's going on in the market right now, they probably wouldn't have to sell. They could have their portfolio and have the income. And actually, to be fair, they could still refinance. I mean, in terms of age of refinance, what age do you go up to?
We go up to sort of 75.
Yeah, well, there you go.
And we do a lot of portfolio landlords at the minute because we don't stress the background portfolio, especially when people, we obviously refinance any sort of size, but then we've got people that portfolio landlords are looking to purchase a new asset. Most mainstream lenders will test your portfolio, stress it in the background. Most people's portfolios are highly leveraged because every time you get a bit of equity in it, you take it out and move on to your next one, don't you? So I think it's sort of a mixed bag. But then my personal opinion is I just think, the buy-to-let investors that are currently selling, it's only going to be another new generation of buy-to-let investors going to buy most of these properties because, first-time buyers not going to be buying a 10-bed HMO in Swansea, are they? So I think it's just going to be replaced with a new generation of buy-to-let investors. But I think it is quite sad that people feel that they need to sort of do that. But I suppose everyone's circumstances are different.
Yeah, everyone's circumstances are different. So that's what we're finding. We're finding portfolios are coming up, small portfolios where people have got 3, 4, 5 properties.
Yeah.
Over the last couple of weeks, I've even had portfolios of 60 odd in the northwest. Wow. Another one we're buying in the Midlands. That's 26 properties. So so these portfolios coming up. Also, the landlords that weren't really wanting to be property investors.
Accidental landlords.
They're accidental landlords. I mean, remember I started like that, by the way. In 1999, I was an accidental landlord.
You run with it though.
I won't go into that right now. I mean, the first property I bought, as soon as I bought it, it went straight into the market crashed. So sometimes it felt like it was me who started the whole property market crash back in 1989.
So we got you to blame then.
Yeah. So however, now it's a different market, and the people that aren't professionalizing, aren't learning the skill sets. What they're doing is they're having to offload. People that are really working on this, just being slightly smart about it. And you haven't got to have it's not rocket science, but you do need to learn what to do correctly.
You need the basic sort of working knowledge to be able to do it. Like you said, you don't need to overcomplicate things. I think when people try and overcomplicate things, it becomes a lot worse. It is pretty straightforward. What am I buying it for? What's my finance cost going to be? What's my exit? It's very simple stuff. I think there's a lot of people, like you said, they're a bit tired and they just can't be bothered anymore. And what used to work 10 years ago doesn't work now. So I mean, and I think that's when you see people using different properties. So what sort of property or type of asset do you see now more people leaning towards? What are you seeing a large growth in sort of people moving away from doing one 2-bedroom sort of apartments or new builds? What sort of asset class do you see sort of rising through the ranks?
So good asset classes to be investing in, from my point of view, are assets that are, so houses, I would say, are better than flats because people want gardens. Although, having said that, it really depends on your area, right? So if flats is the stock available there, then you're going to have to work with that. Yeah. However that works. The levelling up that the government has been talking about, they're not actually just talking about it, they're actually implementing. So always be looking for areas where you can see that the government regeneration programs are actually being put in place.
And there's quite a few of them at the moment. If you look around, especially sort of around London, I went to visit a site the weekend in Acton. And again, that's started off with one or two. Now it's turned into this humongous thing where it's got more buildings going up, more facilities, and as a property investor, it'd be a good time to get in at the stage it is now before everything starts really going boom. So I think it's knowing the knowledge and looking at these areas and finding out what's what.
Yeah, absolutely. So look for these as you say. Yeah? So look for these regeneration areas where it's not just talk. They've actually put some money, put some skin in the game. Now, what that means is you can get in early. So these hotspots that you'll find online are a bit too late. You got to look for the next hotspot. So how do you find it? As we're saying, first of all, look for regeneration money going in. Look at the various policies that the government have got where the levelling up is actually happening. Look at those specific points. For example, home counties right now are very good in terms of also people buying there and people also renting.
So, in your opinion, do you reckon house prices will stay high and in demand? Because we always read in the newspapers, they like to doom and gloom, house prices will drop by 10% and everything else like that. What do you see? Because we know your predictions. You're quite famous for your predictions on interest rates, property market and all of this, and you always talk about your seminars. So where do you see base rate going to, and what do you sort of see house prices doing?
So because we're in the UK, because of supply and demand, we if you check the track record, we all know every time we say house prices can't double again, what happens? Yeah. In all of our experiences, people listening in right now, they double in a space of time, right? They do that. So I would say from the top to the bottom of the market is actually 25%.
Okay.
And that is not just me saying it, that can be measured, and you can measure that back for decades and centuries, actually. And we're discussing here real drops. We're not discussing drops where someone has overpaid or, how can we say politely?
Outbid themselves.
They've outbid themselves, right? So, they got a little bit too emotional, which is very easy to do, and they've paid right at the top. And we'll be hearing this in the newspapers where, you're hearing 35% drops and 45% drops. And, that's nobody's fault. It's, you just don't know what you don't know. So, those are the kind of things that we're going to be hearing. However, the maximum drop is 25. My view is from where we are right now, in our areas, there's a drop of anywhere between 5 to 15%. And we can't say for certain, but it's somewhere in between that. What we do at Premier is we will make sure we hedge the market. So we've already counted for that drop. So that's one thing. And I would say, the way we look at it is that look at it on a medium-term basis. So rather than the sort of the short-term period of 1 to 2 years, really look at it at least over a decade, medium-term. And if we notice over a medium-term, you find that, yes, there's going to be anomalies. Prices will go down, prices will go up. But over that sort of 10-year, decade period, we find that prices tend, in the right gold mine areas, as we call them, gold mine areas, specific postcodes, they do tend to double. And now there are areas with this leveling up where they wouldn't have doubled as quick, but they are doing that because, no one's a fool. Investors are understanding that there are areas which you can jump into which are even better. And they're working the numbers out like we're discussing, and they're jumping into these specific areas, and that is also fueling growth. So over 10 years, I think we're in a very good place, actually. That's my view. So I think we're in a good space. We've got to be able to buy solid assets. Think of it like a business. Make sure you're checking the numbers properly. Make sure that you're investing in the right areas with the right strategy. And I think that will really lead to some good results for people. And I think when they look back, they'll be very happy with themselves.
But like you said, a lot of people, you've got to look, especially if it's buy and hold, you've got to look at a long-term game in it and not be in and out in a few years. You've got to look at the bigger picture across the price of time. So very quickly, just before we wrap up, right, we'll put you on the spot here. Top 3 tips for those that are looking to buy right now.
Number 1, reduce the fear.
Yep.
So that might be through education, that might be through learning, that through getting through the numbers, much of what we were discussing. That'd be 1. Reduce that fear and jump in. The second thing is don't think about the past. Think about what you can do now and moving forward. It took me years and years to build up my self-confidence and to actually value myself. So what I would say is start doing that now if you're not already. just build on that self-confidence if you don't have any, and you can do more, you can do better. Yeah. Number 3 is don't give up your job. Yeah. So you don't have to give up your job. There's a myth out there that you give up your job and so on. You can run this alongside job because you might even enjoy your job or your business.
Yeah.
And even if you don't enjoy your job, you know what? You can build up your assets in the background and you can stick 2 fingers up when you feel like it. At your boss, that is.
Oh, brilliant. Well, look, I just first of all like to say thank you so much for coming down today. That was absolutely amazing listening to you speak. And also as well for the listeners, how can they find you? Where's the best place if someone wants to reach out and see what you're doing? Where's the best place to normally find you?
Go online, Premier Property or Kam Dovedi, Kam. There'll be something that comes up. So yeah, come and see
If
us.
you're not already in their email inbox already, yeah? Well, look, just want to say massive thank you for coming along today. Really appreciate you taking the time. I know you're a very busy guy and look forward to speaking at your next Premier Property event as well. So lots to look forward to.
Mark, it's very kind of you to invite me. Thank you.
Just like to say thank you for tuning in to Let's Talk Property with MFS today. Please don't forget to comment and subscribe and don't miss out on any of our future episodes. If you want to learn more about Market Financial Solutions and what we do, please do visit www.mfsuk.com.